If you've spent any time online lately, you know exactly what I'm talking about. It's this flood of game-changing market talk. Everything sounds so urgent, so important. Well, our goal here is to give you a few simple tools to cut through all that noise, to separate the real signal from the hype, so you can walk away feeling a little calmer, a lot sharper, and way more in control.
You see stuff like this all the time, right? The gig is up. It's so dramatic. It's designed to create this massive sense of urgency, to tap right into that fear of missing out. This, right here, is the classic language of market hype. And today, we're going to take it apart piece by piece.
So that's the big question, isn't it? In this sea of information, how do you even begin to tell what's real and what's just fiction? Well, the good news is there's a method to the madness. We're going to unpack what I call the recipe for confusion, and then I'll give you a few powerful ways to think about it that will help you see things much more clearly. Okay, so what's so clever about these hype narratives is that they aren't usually just outright lies. I mean, that would be too easy to spot, right? No. Instead, they're this really crafty mix of real, verifiable information and totally misleading conclusions. And that's what makes them sound so darn plausible. Think of it like a recipe. First, you start with a real fact, something simple, like an overseas market reopening after a holiday. Then you stir in a legitimate technical signal, maybe a price breaking out of a pattern. After that, you sprinkle in a layer of kind of sloppy math and a really compelling story. And the final touch? You garnish it with words that promise certainty, like guaranteed or can't miss. When it's served up fast, it looks and sounds like expert analysis, but the second you slow down and actually look at the ingredients, the whole thing just falls apart. So our first mental tool is all about deconstructing the language of fear. And we're going to start with one of the biggest culprits, the word stress. Man, this word gets thrown around like an alarm siren, making it sound like a total collapse is just moments away. But what it actually means, well, it's a lot less scary. See, the hype machine hears the word stress and immediately screams, the system is breaking, default is imminent. But in reality, market stress usually just means there's a temporary mismatch. It's as simple as more people wanting to buy something right now than is easily available at that exact second. It's more of a logistical problem, not a sign that the entire system is about to implode.
Here's a great way to think about it. Imagine a restaurant has 100 reservations for a Friday night, but they only have 50 tables. The hype headline would scream, "Restaurant to default on 50 reservations." But you know that's not what happens, right? In the real world, the system adapts. Some people cancel, some show up late, others are happy to sit at the bar. The restaurant gets efficient and turns tables faster. Markets work the same way. They have these built-in shock absorbers to handle mismatches without breaking. So don't let that word stress do your thinking for you.
All right, let's grab our next tool. This one is all about how to handle those huge, headline-grabbing price targets you see from the so-called experts. These big, juicy numbers can be mesmerizing, but they often hide a lot more than they actually reveal. You know, you'll see a number like this just pop up on your screen, a $7,000 price target for gold. Whoa, it's so specific, it's so bold, it feels like a guarantee. It's designed to make you feel like the future is already written. But is it? Here is the single most important thing to remember about this. Forecasts are not contracts. Let me say that again. Forecasts are not contracts. Nobody is legally required to make that price happen. An expert forecast isn't a promise. It's just an opinion about what's possible based on one particular set of assumptions. You know, a much healthier way to think about a price target is to see it as an airport departures board. What does that board show you? It shows you what's possible. It shows you the gates that exist, the flights that are on the schedule, and all the different places you could go. It gives you a map of possibilities. But here's the crucial part. What does that departures board hide from you? Well, it doesn't tell you about the ridiculously long security line just around the corner. It doesn't warn you about the thunderstorm that's about to roll in and delay everything. And it sure doesn't tell you about the last-minute gate change to the other side of the terminal. The board shows you the plan. It hides the messy reality of the trip. And expert forecasts, they're exactly the same. Okay, tool number 3. Let's talk about interpreting charts. It's so easy to just draw a line on a chart, point to it, and declare that a breakout is confirmed. But as with everything else, the reality is, well, it's just not that simple. Take an indicator like momentum. You'll hear someone get all excited and say, momentum is screaming higher, it's a can't miss buy. But thinking of momentum as a speedometer is so much more powerful. A speedometer is great, right? It tells you exactly how fast you've been going, but it gives you absolutely zero information about the massive traffic jam or the red light that's just up ahead. momentum can look its absolute best right before a major reversal. And that right there is the whole game. Context is everything. A line on a chart isn't magic. A rising indicator isn't a prophecy. They are just ingredients in the recipe. The context is what gives the meaning. Is a major market just reopening after being closed for a week? Are there huge policy announcements coming out? The same exact chart pattern can mean two totally different things depending on the context around it. So this brings us to our final and, honestly, our most important analogy. This is the one that really ties all these ideas together. If all those expert forecasts are just a weather report, then your investment plan, that has to be your luggage. But before you can even think about packing, you have to ask yourself one simple question. What game am I actually playing here? Am I trying to be a short-term trader, catching a move over the next few days? Or am I a long-term investor, trying to build a position for the next few years? Because those are two completely different games with completely different rulebooks. And you know the fastest way to lose? It's trying to play a long-term game while using the short-term rules, reacting emotionally to every little headline. I mean, think about it like this. When you pack for a vacation, you don't only pack shorts and a t-shirt just because the forecast promised sunshine all week, do you? Of course not. You're smarter than that. You throw in a jacket, maybe an umbrella, just in case it rains. Your investment plan has to do the same thing. A real plan is designed to survive more than one outcome. So here's the bottom line. If your strategy only works if the market goes straight up without any bumps, you don't have a plan. You have a wish. And in the financial markets, one way or another, wishes almost always get punished. And all of this leads to this one powerful takeaway. Look, the market isn't a person. It's not some villain out to get you. It's just a mechanism, but it is a brutally efficient mechanism for doing one thing: transferring money from the accounts of people who are emotional and reactive to the accounts of people who are patient and have a plan. And here's the best part. You get to decide. You can choose to chase the hype, get tossed around by the noise, and ride that emotional roller coaster. Or you can use these tools, build a resilient plan, and choose to be the patient person in the room. Ultimately, that choice is yours.